Welcome to the Chapter 3 practice problem video. I've got a set for us to cover here related to underapplied and overapplied overhead, and then a lot of things about our cost flows through our job order costing system. So the first one I wanted to look at was exercise 3-4, and that said Osborne Manufacturing uses a predetermined overhead rate of $18.20 per direct labor hour. The predetermined overhead rate was based on a cost formula that estimated $218,400 of total overhead for an estimated activity level of 12,000 direct labor hours. The company actually incurred $215,000 of manufacturing overhead and 11,500 direct labor hours during the period. So the first thing we want to figure out is the amount of underapplied or overapplied overhead for the period. So to refresh ourselves here, if we're looking for underapplied or overapplied overhead, we want to compare the actual or incurred overhead to that applied overhead. Okay? So we're not worried about our beginning of the year estimate in this in any way. It's just our actual or incurred overhead versus that applied overhead. So let's see what we had here. We actually incurred, so I'll start with that one, $215,000 in manufacturing overhead, and we don't know what that total applied overhead was. We're going to have to do the calculation for that. But we do know that the predetermined overhead rate we would have used to apply overhead throughout the period was $18.20 per direct labor hour. So they would have applied that for every single labor hour that was actually worked. In this case, we were told, well, that was 11,500 direct labor hours, okay, actually incurred or used or worked during the period. So total applied overhead, $18.20 per hour times the 11,500 actual hours. So total applied overhead, $209,300. So when we compare actual of 215 to applied of 209,300, our applied is less than our actual, so we'd say that's underapplied. Okay. Let's think about what this would look like if we had our little manufacturing overhead T account. Okay, so imagine there's a line down the center here. Now we did say in chapter 3, and really in chapter 2 as well, I guess, actual or incurred overhead would be debits to that account. And then applied overhead, we would have been applying it to work in process. So that would be credits to this account here. So the unadjusted balance of manufacturing overhead at the end of this period would be the difference between those two. We've got $215,000 in debits, $209,300 in credits. So if I take that difference, I would have had an unadjusted balance over on this side here, the debit side, of $5,700. Okay, that's the unadjusted balance. And again, that represents our underapplied overhead. Okay, our actual was greater than our applied was less than our actual, so we're underapplied. Now, part 2 said, assume the company's underapplied or overapplied overhead is close to cost of goods sold. Would the journal entry to dispose of that increase or decrease gross margin by how much? Let's think about what entry we'd have to book here to get rid of this. So let's say that's the end of the year. The first thing we know we've got to do is get this overhead account to zero. It's got an unadjusted balance of $5,700 on the debit side. So I'm going to need a credit to manufacturing overhead of $5,700 to get that to zero, right? In other words, I'd be plugging in $5,700 and that'd wipe me out to zero. Now the other side of that entry, if we're closing everything to cost of goods sold, means I'd just be debiting cost of goods sold for that same $5,700. So that's my entry to dispose of this underapplied overhead. Now the question then was, well, would that increase or decrease gross margin? Remember, gross margin is from our income statement, sales minus cost of goods sold. It's gross margin or gross profit. It's a measure of profitability. potential income once we get rid of our other expenses? Well, we've debited cost of goods sold. Cost of goods sold is an expense account. So if we've increased our expenses, that means our net income or any measure of profit, our gross margin in this case as well, would be decreased by that same amount. Okay, expenses go up, profitability goes down. So that answers number 2 for us. Okay, next up I wanted to look at exercise 3-5, do some journal entries, everyone's favorite from accounting principles. And then we'll talk about the T accounts. We won't really prepare all those, just make sure we're on the same page of how we translate journal entries to those. So this said the Polaris company uses a job order costing system. We've got the following transactions here in October, A through H. And the first thing we want to do is book journal entries for them. So let's just take them one at a time. Letter A said raw materials purchased on account, $210,000. So depending on how long ago it was that you took accounting principles, some of this stuff was probably a little rusty for you as you read through chapter 3, maybe not rusty at all if you recently had that stuff. But that's okay, just spend a little bit extra practice time on it if you need to. So back to this here, raw materials we know is an inventory account, that's an asset. It's going to be increased with a debit. So we purchased $210,000 in raw materials, and it says on account. So we didn't pay cash up front, so it's got to be some kind of accounts payable liability for that same $210,000. Next up, we said raw materials used in production, $190,000. 178 were considered direct materials, 12,000 considered indirect materials. So as you read about in chapter 3, anytime we're recognizing the use of direct materials and indirect materials, or direct labor and indirect labor, got to just be careful about where we send those costs. The direct costs go directly to work in process. So in this case, we're saying 178,000 in materials represented direct materials. So book those costs to work in process. The indirect costs go temporarily anyway to manufacturing overhead. Right? As we know later on down the line, they're applied to work in process as we work on jobs. But for now, we're booking that as a debit to manufacturing overhead. So in this case, that's 12,000. And again, this was all used up raw materials. So we got to take it out of the raw materials pile, if you will, and out of that account, the total of 190,000. And we're showing on this side where those things went. 178,000 direct materials, so send that to work in process. 12,000 in indirect materials, send that to overhead. Okay, C said accrued direct labor cost of 90,000 and indirect labor cost of 110,000. So very similar to B, but this time with labor costs. If we think back again to accounting principles, accruals just means I'm recognizing it but haven't, paid for it yet, essentially. So the direct labor cost, again, we'd send directly to work in process here, 90,000. The indirect labor, we'd be sending, at least temporarily, to that manufacturing overhead account. It's 110,000. Now that means we need a matching credit here for the total of 200,000. And this would be something like, wages payable. Again, it indicates we haven't paid it yet. So it's got to be some kind of payable account there. Next up, we had depreciation on factory equipment, 40,000. This one, a little tricky, because we think about accounting principles, we always had the depreciation expense account. We worried about that. That would be fine here if we were thinking about, administrative equipment, like desks and furniture in the CEO's office. Right? That would be depreciation expense, because that's a period cost. But for any product cost, it's got to flow through inventory. So that depreciation we're going to book as a debit here to manufacturing overhead for 40,000. And then on the credit side, we do still have that accumulated depreciation account, equipment, the contra asset for $40,000. Letter E, we had other overhead costs accrued during October, $70,000. We don't really have any detail there, so let's just go ahead and put all of it to manufacturing overhead, the debit, the actual cost of 70. And then the credit, we do know that it says accrued rather than paid. So rather than using cash for the credit, let's just say accounts payable. Some kind of payable there, whatever you prefer. F, we had the company applies overhead cost of production using a predetermined rate of $8 per machine hour. A total of 30,000 machine hours were used in October. So as we'll recall from our earlier study in chapter 2 and 3, our applied overhead is always our predetermined rate. In this case, $8 per machine hour, times our actual activity, or in this case, 30,000 machine hours. So we're applying 240,000 in overhead. Now, what are the accounts we need here? Well, we're applying that overhead to, we always apply overhead to work in process. So then, of course, the matching credit is that manufacturing overhead account. Okay, just be careful there. You don't want to be applying overhead to finished goods or to any other inventory account. Always want to make sure we apply it to work in process. Just a couple more then. G said jobs costing $520,000 according to their job cost sheets were completed during October, transferred to finished goods. So finished goods is an inventory account. We're going to be increasing that with a debit here for $520,000. And then we just want to think about where that's coming from. These are jobs that are just now finished. So right before that, they would have been in process. So they'd be moving from work in process to finished goods. And then one more step for us here. Jobs that had cost $480,000 to complete according to their job cost sheets were shipped to customers during the month, so now sold. And those jobs were sold on account at 25% above cost. So really we're going to want two entries here. One to recognize the sale itself and the revenue that goes along with that. And then another to recognize the flow of inventory. So let's start with the sale. These things were sold on account. So we've got accounts receivable. We know that these jobs had cost $480,000 and we're marking them up by 25% on top of that. So if we multiply the job cost here by 125%, we'll be adding that 25% markup. So sold them to customers for a total of $600,000. And then the matching credit there, sales or sales revenue for that same $600,000. And now we can update our inventory. These goods would have moved from finished goods. That's the only place we sell goods from, right? The stuff that's done and ready to sell. And now going out the door, finally hitting that expense account, cost of goods sold. So increased cost of goods sold with a debit for $480,000. And then decrease that finished goods stockpile, that inventory account, by the same $480,000. Now part 2, it said prepare T accounts for overhead and work in process, post the relevant transactions from above each account, come up with an ending balance. So yeah, actually let's do that here. I'm going to kind of try to do this off to the side. Let's start with that manufacturing overhead account. So again, debits on the left, credits on the right. We had a debit here in B when we were doing materials for $12,000. We had a debit in C for labor, $110,000. We had another debit for that depreciation, $40,000. Another debit here for some other overhead of $70,000. Then we finally applied a bunch of overheads. We had a credit, $240,000. And that was it for overhead. So let's determine what our ending balance in overhead would be. So again, I'm not going to use cell references, try to make this explicit. Add up all our debits, and we get a total of 232,000. Our one credit, 240,000. So if I netted those out, I'd end up with a credit balance of the difference, 240 minus 232, or $8,000. This is the unadjusted balance in manufacturing overhead. Incidentally, since applied, credit side to overhead account, is greater than the actual debit side, we know that this also represents over-applied overhead. Let's also come up with a T account, I guess, real quick for work in process. Again, debits on the left, credits on the right. We knew that the beginning balance here, as told, was 42,000, so I'm going to plug that in quick. Then what did we do to work in process? We increased it for some materials, 178. We increased it for some labor, direct labor, 90,000. We increased it when we applied overhead, 240,000. And then we moved a whole bunch of stuff out of it when we finished some jobs, 520,000. So again, let's come up with some totals here. I'll avoid the cell references to make sure we're explicit. Just adding up my total debits, 550,000. My one credit is 520 there. So if I net those out, looks like I get an ending balance here of 30,000. That's the 550 in debits minus the 520 in credits. And just to be clear, this balance would show up on the balance sheet at the end of the period. Show up under inventory, that work in process account. Carry forward to the next period. Okay, I wanted to scoot ahead here to 3-6 and give us a shot at a schedule of cost of goods manufactured and cost of goods sold. So this is the following data from the just completed years taken from the accounting records of Mason Company. We've got sales of 524, direct labor 70, raw material purchases 118, selling and admin expenses 140 and 63 respectively. We know the overhead applied to work in process. We know the actual overhead, and then we know the beginning and ending inventory for all of our inventory accounts, raw materials, work in process, and finished goods. So the first thing we wanted was a schedule of cost of goods manufactured. So if you need to, stop and review that real quick. What we're trying to show with that is the cost of the goods manufactured, aka finished during the period. The first thing we want to start with then is our manufacturing costs added in this current period. So we want to figure out what the direct materials used were. It says here, as a hint to number one, assume all raw materials used in production were direct materials. So let's figure out what we used in direct materials. Well, we started the period with 7,000 in raw materials. During the period, we added to that purchases of 118,000. And then at the end of the period, we still had 15,000 left. So the difference there must have been what we used. Again, that's what we started with, plus what we added to it, minus what we had left over, must have been what we used, 110,000. Now to that, we also want to add direct labor. We knew what that was. Okay, given explicitly there is 70,000. Oops, not 7,000, 70,000. And then our third bucket would be overhead, and we just want to be careful there. That's overhead applied for this purpose. We'll worry about the applied versus actual in just a minute. So here the overhead applied was told to us at 90,000. So this would be total manufacturing costs. Direct materials of 110, plus direct labor of 70, plus overhead applied of 90. So there's 270. Now to get to my cost of goods manufactured, aka finished, I need to reconcile that total manufacturing costs added in the period with my work in process beginning and ending balance. In other words, if I add the beginning work in process of $10,000 to those total manufacturing costs, that would give me my total cost of work in process during the period. Okay? In other words, all the cost I dumped into it, 270, plus the costs that coming into the period were already there, so to speak, of 10,000, means the cost of everything I was working on in the period, 280,000. Now, if I take out the ending cost of work in process of 5,000, the stuff that still wasn't finished at the end of the period, the difference must be that cost of goods manufactured, aka cost of goods finished and moved to finished goods in that same period. So total cost of work in process 280 minus ending work in process of 5 means I manufactured or finished 275,000 in goods in this same period. So that, in its abbreviated form, is our schedule of cost of goods manufactured. The bottom line should be, what is that cost of goods manufactured or finished? Another thing for us to go ahead and point out, since this does represent the cost of goods finished or manufactured, if I happen to look in my journal or my T accounts, I would see a debit to finished goods of that 275,000 and a credit to work in process for that same amount. Okay, this entry would represent cost of goods manufactured or finished, moved from work in process to finished goods. Now, the second part said prepare a schedule of cost of goods sold. Assume the company's underapplied or overapplied overhead is close to cost of goods sold. Okay. So schedule of cost of goods sold, we want to start with our beginning balance in finished goods. The stuff that was done and ready to sell at the beginning of the period. So that's $20,000. We're going to add to that the cost of goods manufactured in the period, the stuff that was finished this period and made ready to sell. And that's coming straight from our schedule of cost of goods manufactured. So if we add those up, 20,000 plus 275, there's 295. That's the cost of goods, abbreviate again, available for sale. Now, if I take away the ending finished goods balance, the stuff that's still unsold at the end of the period, in this case 35,000, that's got to be my cost of goods sold, the stuff I actually got out the door this period. So cost of goods available minus ending finished goods, and there's my cost of goods sold. And by the way, just to be clear, that's the unadjusted cost of goods sold. Okay? We need to adjust it here for this underapplied or overapplied overhead. Now let's figure out what that was, and let's think about the overhead T account real quick. Debits would be our actual overhead incurred. So if we look back in our box here, actual overhead costs were 80,000. Overhead applied to work in process was 90, so that would have been all of our credits this period. So our unadjusted balance in overhead would have been the 90,000 credit minus the 80,000 debit, or 10,000. This is unadjusted balance. So we would have closed that out to cost of goods sold, right? And the way we would have done that would be to wipe out the overhead account. So we need a debit here for this matching 10,000. So my entry would say debit overhead, 10,000 bucks, and then credit that cost of goods sold for the same 10,000. Again, this would be the entry to dispose of that over-applied, in this case, overhead. So given this entry, I now need to adjust my cost of goods sold on my schedule of cost of goods sold. Unadjusted cost of goods sold was 260. This entry to clean up the over-applied overhead would be a credit to cost of goods sold for 10,000. So that would be reducing cost of goods sold by the same 10,000. So we'll just stick here on this schedule, less adjustment for over-applied overhead, 10,000 bucks. And now we've got, just to be clear here, the 260 minus the 10,000 for an adjusted cost of goods sold balance of 250,000. Okay, so on the income statement, this is what I would see for cost of goods sold, the adjusted amount of 250,000. Oh, and that was the third part, to put together an income statement. So let's do that real quick. Income statement always starts with sales. So we had 524,000 there. We'll use our traditional format income statement, so we'll say less cost of goods sold, and that's our adjusted amount that we just calculated here, 250,000. So the 524 minus 250 leaves us a gross profit or gross margin of 274,000. And then we would take away our selling and admin expenses. I'm going to combine those in one line here. We had selling expenses of 140,000, admin expenses of 63,000. Is a total of 203. So the difference here of 71,000, and again that's the 274 gross profit minus the 203 in selling and admin expenses. That is our net operating income. And that's our short form income statement. So that finishes up 3-6 here. Next up, I had exercise 3-8 on my list. We'll scroll down to that here. And 3-8 said, following information is taken from the accounts of Lotta Company. Entries in the T accounts here are summaries of transactions that affected those accounts during the year. So we see everything that's posted here to the T accounts. We're also told the overhead that had been applied to production during the year is distributed among work in process, finished goods. Cost of goods sold is the end of the year as follows. First up, we want to identify reasons for entries A through D. A through D. So I think I could fit most of this on the screen here at one time. I'll jot down some notes about it as I talk about it. So let's look at entry A first here. We've got a debit to manufacturing overhead of 460,000, and we don't see that credit in any of the other accounts they've given us here. So the matching credits were in some other accounts that aren't shown. What we do know is that any debit to the manufacturing overhead account represents actual or incurred overhead costs. Okay? So those could be things like, you know what, I'll just drop a couple down too. Property taxes, depreciation, utilities, et cetera, et cetera, et cetera, or even indirect labor, indirect materials. Right? Could be all those things. Bottom line is it's actual or incurred overhead costs. The matching credits are somewhere else, in some payable accounts, in some cash accounts, whatever else. Letter B, we had a credit to overhead of 390,000, and this time we do have a matching debit in work in process for the same 390,000. So credits to the overhead account always represent applied overhead. So what we're doing here is applying overhead to production. Credit to overhead, debit to work in process, like we did in the earlier problem when we wrote out the journal entry. Okay, letter C, we have a debit here to finished goods, 710,000, and a credit to work in process, 710,000. So we talked about this in previous problems as well. We're representing with this entry the cost of goods manufactured or finished, aka finished, during the period. Okay? Moving the cost of those jobs from work in process to that finished goods account. That's all that represents. And then D, we had credit to finished goods, 640, matching debit to cost of goods sold for 640. So we spoke about this a bit earlier as well, right? Now we're finally recognizing the cost of these things hitting the income statement. And the only time that happens with our product costs or our inventoriable costs is when goods are actually sold. They finally get out the door to the customer. So that's the flow we're showing here in D. Okay, number 2 said, assume the underapplied or overapplied overhead is close to cost of goods sold. Prepare the necessary journal entry. Okay, when we look at the overhead account, the unadjusted balance is $70,000 on the debit side. So if I'm going to close that out to cost of goods sold entirely, I'm going to need a credit to manufacturing overhead for $70,000. Right? That would get me to 0 in the overhead account if I had a matching $70,000 credit. And then the other side of that, I'd need a debit, so I'm going to debit that cost of goods sold account for the same $70,000. So just to be clear, this is to dispose of the underapplied overhead. And the reason it's underapplied is because actual is greater than applied, or applied is, less than actual, depending on how you want to think about that. Now the third part said, assume the underapplied or overhead is close proportionally to work in process, finished goods, and cost of goods sold. You can actually ignore that for our purposes. The only thing I'll ask you to worry about as far as disposing of that underapplied or overapplied overhead is entirely to cost of goods sold. So we can just focus on that. Okay, that wraps up the Chapter 3 practice problem video. As always, back up and review any you need to, or feel free to send me any questions you have. Talk to you next time.